Ganesh, my audio is perfect, right?
Yes, sir. Hope mine is audible as well. Thank you, sir.
We'll start in next 3 minutes.
Good morning, everyone. Thank you for joining us today on our webinar, Common Questions, Uncommon Answers, the Solitaire Way. Today, we have with us Mr. G.R. Balaji, Head of Research and Co-Fund Manager, and also Mr. Ganesh A., who's the Associate Vice President of the PMS side. I invite them to begin the session.
Thank you, Poonam. Good morning, everyone. Thank you all for joining us today on a Saturday morning. I know it's not easy being the IPL season, right? We all want to have a quick siesta on a Saturday afternoon, eat well, and then continue. So thank you for joining us today. And today we're going to talk about what are the common questions in an investor's mind usually, right? So we all have these common questions in our mind as investors, and we do not know where to find the answers to. So these kind of questions linger in our thoughts constantly, but we somehow end up getting a very similar answer from multiple sources, right? So what we thought at our within our team, right, was how can we provide something which is uncommon to the public knowledge, right? How can we add value to the existing system by doing so? Because you've had a common question for a long time, and you've had a very common answer to it for that period of time. And what we thought was, let's give an uncommon answer to these kind of questions which commonly linger in an investor's mind. That was the reason why we chose this kind of format, and we are planning to do this with every product of ours. With Solitaire today, we would be taking you through a specific set of questions that you would have in your mind with respect to a multi-cap fund or a similar type of a fund, or which is a comparable fund to Solitaire. And then so that you can make an informed decision when it comes to when that question once again comes to your mind. So with that, let's begin our session.
Okay, thanks, Ganesh. Very good morning to all. I think precisely what Ganesh spoke about is we consistently keep getting certain questions, right? As part of an investment team, is it right time to invest? Markets have run up sharply during last 45, 50 days, right? Around the March end, we were looking at an index of 16,800. And suddenly we are all close to 18,000, right? Suddenly the markets have risen very sharply. So what we thought is, instead of giving a generic answer, it's very important to talk a very rational, a specific sort of a reply, right? A logical reply, which is very specific so that it helps all of us to take decision, right? So the whole idea about today's session is, can we take a well-informed decision? To start with, few questions we would like to answer, and then we'll open up the floor for Q&A, where request a lot of interaction, where whatever doubts, clarification you think need clarity, right? We'll be very happy to answer, except maybe a stock specific, because that's not our agenda. So the first and the foremost question, right, which comes up to all the mind, right, including us every day, market is close to all-time high. Is it valuation is expensive? Okay, why do these two questions? If you move on to the next, right, can I just click once? The question why we are asking this is the pertinent question coming in our mind. If markets are expensive or all-time high, if I have capital, do we have enough opportunity, right? I think whether we ask explicitly or implicitly, this is what it meant when we believe when valuations are expensive, why we take hesitant. Obviously, right, when things are expensive, why would I like to put money? And when markets are all-time high, general belief is nothing is cheap, correct? It's actually a fair point. Definitely a segment of the market is expensive, right? When market is all-time high, definitely few stocks are at all-time high. That's why the market is all-time high. So definitely a pocket of market should be expensive. It's a very fair conclusion. But to conclude everything is expensive might not be a right way. That's where I thought we will bring that uncommon answer, which is what Ganesh alluded. So moving on to the next slide, which gives some data point. I would like to talk with the data because that's what I believe in. So Nifty is close to 3% lower than the market. It's 2 days back, I've taken the data. Roundabout, we are close to there, right? It's not a big change, right, between what the data is and what is today. But what is very interesting is, we all know the index, right? Because every day morning, there is a lot of my friends, and I'm sure a lot of well-wishers keep doing is, they see Nifty. Nifty is all about 50 stocks. To put in perspective, we have more than 5,000 odd stocks listed. More than 1,500, 2,000 stocks get traded every day. Nifty is only 50, right? So what happens to that 50 reflects in Nifty. That's all I think I will sum it up. There is beyond Nifty. That's something which I sincerely believe, and the data is also suggest. 201 stock out of BSE 500. So I've taken BSE 500 as a broad universe for two reasons. These are well researched, well governed, highly good in communication. That's why they're part of the index. They are reasonably liquid, and it's part of our index also, right? For Solitaire, currently it's BSE 500 TRA index. So that's where we have put this index and saw how many stocks are still down reasonably, right, from a 20%, right? So I would say a 20% is a reasonable fall, because that's where the point of bear market starts, typically from a market context. There are 201 stocks. It means close to 40% of the BSE 500 universe is still not only 20, right? Some stocks are 30% lower, some stocks are 40, some stocks are 50. And you have close to at least 100 stocks which are investable, right? In terms of quality of balance sheet, governance, cash flow, growth. I think it gives you a good universe. So this is my first data point to talk in terms of, there are very, very well-run companies across the sector, which I'll substantiate in the next slide, is available, and they are far, far lower than their highs, right? So it's not the entire market is up. I hope that point is very clear. The number is 201 as of day before yesterday. Now, if again I double click, right? So the natural question, is it a very investable universe is there, or it's more of a stock which is not? Is it belong to only one sector, or is it multiple sector, right? It's a very natural. This is again a sample set. I've not taken all the 201 because it becomes a noise, but I've taken a reasonable large sector, which you and I are very well familiar predominantly, and it's our investment universe, right? Because a lot of mutual fund, a lot of PMS, a lot of prop book do invest in this sector, right? This is not unknown sector. So chemicals obviously been a darling, fallen. The reasons are many, but I'm not saying we are very bullish, but then the pockets have corrected, right? So there could be an idea which can emerge at some point in time, given the growth and the valuation. Healthcare, a very, a very core to India, right? India dominates in this space globally. If you go to Europe, if you go to US, I'm sure we are very aware the requirement of our healthcare is pretty high, right? Right from Sun Pharma, Cipla, Lupin, so on, so forth. And there are many companies out there down and substantial, right? 17 stocks. IT, again, if you see first three straight away connects to a global, right? And it's very, very simple, right? US going through slowdown, Europe is going to slow down, and that's getting reflected in the stock price. A lot of IT stocks are down substantially, right? The front line itself is down 30-40%, and the mid caps are down 40-50% also, right? So I'll share some more data. And we know for last 20 years, one of the greatest wealth creation happened out of India is IT sector. So consumer durable, again, a most loved sector pre-COVID. Now it's gone down because of excess supply, low demand. But so they are not hit all-time high, right? Then you have financial institution, which is non-lending. There are 9 institutions which is down more than 20-30%, which could be from asset management company, wealth management company, a broking firm trying to transform to a wealth management, multiple business. And finally, retailing, again, erstwhile darling. If you see value retailing is going to a tough phase because of rural India is slugging slowly. So I see there are many opportunity beyond this also, right? So in some substance, it's not every pockets are firing. Definitely few engines are firing, like capital goods, private banks and PSU banks are doing extremely well. Pockets of FMCG is also has come back strongly, right? A very meme stock has turned to be the darling. So we are seeing a very big transformation in some pockets. At the same time, there is a good opportunity available in other pockets. So that's point number 2, which I thought I'll bring it to you. Hope it helps. So moving on to the next. So what was our first question, right? To start with, market is all-time high. And this is not the first time market hit all-time high. And I wish and I pray, because neither I have visibility, but I think going by the past data, all-time high is like our age, right? As long as you're adding value, which is what Indian corporates does. Simply put, our return on equity of Indian corporate is 16%, vis-a-vis cost of equity of 12%. It means we do add value by doing business. So that's why I say when you add value, it will slowly show up in the markets. So our all-time high is a very recurring event. So during 2020, market hit close to all-time high. And if you see the picture, it looks straight, reasonably upward curve. So if someone were to come and ask, is it time to invest? Is it right time? Obviously, right? By seeing this data, you'll always might feel, okay, I did not invest at 7,500, which looks low. Ideally, that should be the time, but nobody invests, right? Because no one knows the low before. And markets have come back by 50-60%. So a very easy way to conclude is markets have run up, so it has to fall. Yes, it did fall, but for a very different reason. So if you want to move to the next slide, the first circle which I have done, which is on 2020, is the same point we spoke in the previous slide. But market fell because of COVID, which was a very back very sharply. And within a year, we have hit another high, which is close to 18,000, right? So the whole point is, instead of talking, okay, by absolute level, index has gone 18, it has to fall, or index has gone to 17, it has to fall, or at 20, it has to fall. As an allocator of capital, our job is to find opportunity within the market. Definitely, as I shared in the previous data, where chemicals, IT, pharma, consumer durables, retailing is much, much lower than what the 52-week high they have attained. And market also do come back, right? Because we are in such a very strong economy, which has been now conquered by the entire world. And this data clearly points out all-time high is a recurring one. And as long as you have a capital, which is a 3 to 5 year capital, which is what ideally an equity investor should come in, I think market opportunity is extremely solid. Moving on to the next slide, 5 year return. Okay, what is the 5 year return of Nifty to?
Sorry, you're on mute.
Sorry. I lost my connection. Extremely sorry. My apology. As we speak, the 5 year return of Nifty is only 13%. To put in again perspective, the long-term return, which is 32-year of the market return, is 11 to 12%. So if I broadly were to see, markets have just delivered what they are supposed to deliver, right, in the last 5 years also. Because India at a nominal GDP at 11%. If I break the nominal GDP, India does 6% real GDP and 5% inflation. Obviously, last year inflation was little high. But if you remove last year, broadly our inflation is close to 5% in the last 8, 9 years. So with 11% nominal GDP, markets are expected to generally track the nominal GDP, provided we add value. And as I've shared the data, Indian corporates do add value. And market returns is 13%, right? So it's actually good market, neither very, very buoyant, and neither it is very, very suppressed. To see the previous slide, Ganesh, can you just go? Last 18 months from October 2021, sort of it, market's been consolidating. It means last 18 months, we have just been consolidating. So it's actually a fantastic phase who have capital with 4 5 years perspective coming into the market where markets have spent enough time around 18,000 for last 18 months and giving you a window to buy back the same assets at a similar price or a lower price, right? So this is why I say, if you have to invest in India for next 3 4 years, I think no better time than could be around the corner, because we have already consolidated. The froth is out, the exuberance is out. Obviously, this is not the cheapest market, but this is not the expensive market. So to make a good average outcome, definitely markets are there. And obviously, right, our job as ithought team and as an endeavor is to buy durable assets which are little more cheaper than the market, right, to deliver, which I'll share it to you in the subsequent slides. So move on to the next. If you see, sorry, before slide, Ganesh. If you see, even though markets have delivered 13%, 91 stocks have delivered 0% in last 5 years, right? Again, there is a 20% of the market has just not done anything for 5 years, right? Maybe a few ideas comes from there, right? That's a typical way as a research team, we hunt for the ideas. If you see 159 stocks, apart from this 91, is delivered less than 6%, which is close to your inflation, right? Again, nothing substantial. So again, there are very different data points shared. There are close to 200 odd companies have not done anything in the last 5 years, and any good positive progress on the business can unlock value, right? That's where investing is not about just seeing the index. I think I'm sure with both this data, this point has come out very clearly. I hope we are able to bring out that clarity to all of us. Moving on to next. One of the sector which we turned very positive during last 6 months, but it's a very case specific, is IT. Obviously, right, we are very well aware what's happening in US and Europe. But as an allocator of capital, we have to be very clear. We are in for a medium term, which is 4 to 5 years. And when do we can buy a good asset? The simplest way to buy good asset is when that asset goes through temporary problem and structurally they are profitable, right? So we know for sure IT as a segment has been extremely profitable for last 20-25 years, and India is definitely a right to win, right, from an IT point. That's a long term. So that's where the positivity comes in. What is the negativity today? Obviously, next 6 months, next 9 months, US economy is not in a great shape. Europe is not in great shape. So the demand environment is more subdued. It is not a negative growth. They will have a lower growth from a double digit to a single digit. But think about, you're able to buy a long-term asset with a slight temporary problem, which could be 6 months to 9 months. But you're buying at a yield. Today, we bought a couple of names with a 4 to 5% of dividend yield. When the market yield is today 1.5 to 2%, right? So you're buying at substantially cheaper, a great asset. And today IT is providing that opportunity, but definitely in pockets, it's not a generic command that you go and buy any IT company. But if someone says there is lack of opportunity, please see data. The best dividend yield for IT companies available right now, right here. And I think that's where the opportunity lies. It has to be specific. And I'll share some example about how we looked at some idea and it turned out to be a great success. Moving on to the next, valuations have become very reasonable. The long-term average of Nifty is around 20 times. We are trading between 20 to 21 times on a given day, whichever we have to speak. So broadly, it's a market where the valuations are reasonable. As I told in the beginning, we are not in a cheap market. That happens when there is a crisis and so on and so forth. But neither we are in exuberant market, right? So if you have a disciplined saver of a 4-5 year capital, I think market is well positioned to deploy that money. Moving on to the next. So having answered the first question, which is elaborate, but I thought it's very important that all of us get that perspective. The natural question comes up, is it right time to invest now, right? How do we take decision when there is uncertainty? I'll tell you one thing very confidently, being in the market for last 20 odd years, uncertainty is always there. There is no day where we can say it's only certain, right? Because neither we are God, and I don't wish to be. So the whole point is market commentary can change big time, is saying it's uncertain, it's VUCA world. We have to be careful. The world will be always volatile. The only difference is at some time the volatility will be suppressed. Sometime it gets exaggerated. Otherwise, volatility is the nature of the beast. Uncertainty is nature of the market. Uncertainty will always be there, but we are supposed to take decision, and I'll tell you how we think about it. Moving on to next. So what if I just created a scenario, which is a live scenario. What if someone would have told in 2020, you're going to invest and this 5 worst things can going to happen in the next 2-3 years, right? So if someone is going to foretell us saying, hey, Balaji, you're going to invest now, but you're going to face COVID, which unheard of for anybody, right? It's like a tsunami, right? When the first time it came, I was Googling and trying to figure out what is COVID. A lot of us got really shocked. I think personally also a lot of went into trouble, right? So it was one of the disaster which we have faced. We have seen war. Few generations have not even seen a war like this. It's continued now for a very long period, right? We only read about wars typically, but now this war is happening for real and it's happening for longer. We have seen a record interest rate hike in the Western economy due to record high inflation. US as a society never experienced inflation more than 2-3% for last 20-30 years. And today they're experiencing inflation close to double digit in Europe and higher single digit in US, and high political risk, right? Geopolitical risk is very high. If someone were to say, if you're going to invest now and next 3 years, you're going to happen all this, right? Foretelling. What is a natural response for all of us, including me? A very natural response was, these things are very terrible. Let me not do any decision, right? Because that's the simplest way to operate. But let me share some data about what can be known, but market might not respond the similar way. That's what I would like to believe. A market opportunity is very specific. So the most likely outcome is, let's wait and watch. But we have taken a live scenario where a Solitaire, our fund is close to now about to be 4 years in next couple of months. So we have live data about client who came just before COVID, right? But definitely we did not knew, but having known and having invested, right? What has happened to them? It's a good experience for you to know. Ganesh, you can just. If you see the client has made 19.97% CAGR return, the same period what I've told, right? Where the client has invested, COVID came, market fell. then market recovered, war came, interest rate went up, inflation went up, geopolitical risk. I mean, everything has happened, right? Big drama. I don't think no one would experience in the first 3 years of a fund experience of such dramatic scenario. But the fact remains is markets have gone up. Markets have gone up by 14.16%, which itself is a very healthy return. And definitely, as a house, we have done very well. We're very happy for the client who entrusted the money, who stayed invested, 19.97. But the beauty lies is not only at absolute CAGR level we have delivered this with 25% lower risk, which reflects in the beta of the product. So clearly, by taking lower risk, we are able to add substantial value. And the 3 years where all these events have happened, which is real, right? So one of the big takeaways, people can say monsoon can fail, elections can happen. Yesterday, 2,000 rupee notes got, obviously, right, you have to go and change it. So there is always a reason to worry. But the entire world believes if there is one trade for next decade, that's India. And the world is completely agreeing, right? Everybody is saying you have to be on India with India. And no better example than Apple, the world's largest consumer brand, started the first retail shop in Bombay and then Delhi and saying India has hit the tipping point. I think it's very clear. If you are believing 20 years, 10 years story, right? India is a great story. And that's where, with so much tragedy out there, markets have delivered what they have delivered. Moving on to next. So the one of the other question keep coming for us is, as a house, we are very unique in terms of distribution. We don't actually distribute through outside. We have our own channel. Our own team members only talk. Why do we do that? We strongly believe starting point of an investing is just a journey. A journey has many stops before we reach our destination, right? So one of the very active thing as an ithought we do with our prospects and the client is we engage with them at an intermediate level wherever there is an opportunity. And one of the questions keep coming up is, why do we ask incremental capital having given the large capital, which is 50 lakhs, right, in a PMS? Let me give you one small example about these two ideas where it was part of our portfolio, one still part of the portfolio. So the stock, which has hit 147%, if you see, predominantly it actually trailed the benchmark, which is in the red and green. And in the last 2-3 months, 4 months, when the results came better, the stock became the best performer. If you see on a 3-year horizon, this is the best performing stock. But if you see first 2 years, the stock actually underperformed. So a lot of people were worried, oh, the stock is not going anywhere. Why do you buy other stock? The whole idea is, if you see other stock, as soon as we bought, the stock went up. So the whole idea is, in a 3-4 year period, we can be right on both stock. In this case, both were right, but the timing could be very different. So that's where we strongly believe ideas do come at different point in time. And if you have capital of 3-4 years, you're just funding your own portfolio, right? You're not giving to us. You are funding your portfolio and trying to see if any incrementally new opportunity comes, will be observed. And the existing opportunity sometime might take time. I'm not saying every opportunity first will underperform and then outperform. There will be opportunity where straight away it can outperform. But the whole idea is you have to give time. And clearly with this example, we also got reiteration that holding on to good company is the best thing to do because it just takes 2-3 months to outperform substantially, right? The last 3.5 years, markets have delivered 65. The stock, which has gone up upper circuit, recently it hit upper circuit, gone up 147%. But only all the performance has come in last 4 months. So that's where we have to be patient with our stocks. It is not like every day it has to go up, but we continue to monitor the stock. We actually flew down to Kolkata to attend the AGM of the company. We took a lot of questions. We actually spoken to their global MNC company to get the perspective. So we were on top of our research, but we were patient, and patient got extremely rewarded. Moving on to next. So what are things to monitor when stock doesn't go up, right? Definitely, stocks are not your FDs where every day it goes up. So we need to monitor. And what are things we daily monitor? I think the least paid attention in the market is research is one time. Actually, no. research starts once we have completed the first research, because the monitoring is the biggest process. And these are only 6 things I have put out. There are many things we monitor, but what do we monitor, right? Quality of the balance sheet, right? So as a customer, if you say 4 stocks has not gone up, Balaji, I say, okay, right? Monitor these 6 things. Is the quality of the balance sheet is good of your company? Why? It helps you to survive. And no better lesson is learned during COVID. The guys with cash free survived a lot. Quality of profitability, right? Return on equity. As I told, you do value if your return on equity is above the cost of equity. So measure it. If your return on equity is good, it's a good company, right? Market position. Is the company is relevant to the customer, right? It reflects in the ranking, right? So see, is your company is profitable and ranking among the top 3, top 5? Market share gain, multiple operating numbers can be measured. Finally, the 2 operating numbers we track every day is sales growth and operating profit every 3 months, right? So this 6 measure will give you are in a good company, and sometimes the price might not move. And I think no better time for the meme stock which we held, right? ITC, we held very steadily in most of the portfolios. Turned out to be a great winner, right? We bought around 180, 200 level with 5% yield, return on equity upward of 30%, adjusted cash return on equity is upward of 100%, full free cash flow business, growing steadily. But the market pain was ESG, market pain was FI selling, both are non-fundamental. And when things turned, last 2 years, the stock has just doubled within, and it's a nifty stock. Clearly, once you buy a good asset, all we have to do is patient. But the first 2 years, ITC was a dead stock, right, from performance. So the whole message is simple again. When the price doesn't move, we have to monitor the fundamentals. And as long as fundamentals are good over a period, price do move. Moving on to next. So this is a small example again, without the name. Last 8 months, those who have been our client, I'm sure they would have known that we got an interesting idea on IT. When the entire market said IT is bad, don't buy any IT company. I think this is what a disconnect, right? When you brush everything in the same way, you will find some opportunity. And we found a very interesting opportunity, which is a very niche small cap IT company with a dividend yield of 5%. Look at the dividend yield, right? So you're buying margin of safety, you are buying value. At the same time, the growth is expected to improve because this company was servicing aviation industry, which is just coming out, right? So clearly the growth is picking up. Market was concerned for next 3 months. And we said in the next 2-3 years, the growth will come back and stock will re-rate. How lucky or unlucky, I don't know. As soon as we bought, the stock underperformed for a very short period. And as we see in the last 9 months, the stock is up 60% and the market is up 12%, right? This has happened in IT, a debt-free company growing. So again, same point. There will be always an opportunity will come and you need to capture it. And that's what our job, right? As an allocator of a capital. I'm not saying every idea will work in 6 months, but this is one such idea where it just came in and just actually flew off. And within a sector where everybody is saying, yesterday 3 IT stock hit all-time high. So those who say IT is bad, nothing is happening, see the data, 3 stock hit the lifetime high price yesterday. So clearly reflects some stocks do very well within the sector also. So to sum and substance, having shared markets are very reasonable, there is opportunity. How do I would like to sum it up in a world where data is everywhere, but opinion is very loose? We would like to form our opinion in a very structured manner. If you become our client or already you're our client, you will be knowing, we will be looking at the data in this format. Global macro, as per our perspective, we will see a slow growth both in US, Europe, Japan. You might see some recession for a short period. Don't get, that's actually known fact. Inflation is very sticky. Europe inflation is double digit. Even US inflation is reasonably sticky, around 5-6%, not a healthy sign for them. But interest rates are peaking. Broadly, Fed is also commented, we are reasonably close to end, but we have to watch out. But political risk is very high. So in sum and substance, global macro is not in a great setup. If you look at India, right? So that's a beauty. Life is very relative. When the world is in that shape, India growth is moderate. We are going to grow between 11% odd, between 10.5 to 11.5, whichever estimate we were to see. Our inflation is reasonable and not terribly high. As a society, we always seen inflation in the past also. It's okay. Our policy tightening also close to an end, right? Last policy meet, we did not have an interest rate hike, even though the governor said it's a pause, not a pivot. But we are happy to see this pause, which is a good sign, and that's why the market started rising. So markets at global level will be volatile. You're going to see a mixed information. But we as an investor are going to invest in India. So let's squarely focus on India. Corporate balance sheet is healthy, which is a foremost factor because your corporation is going to invest into business and which will generate profit and then the dividend and the cash flow. Results are coming pretty good. To put in perspective, within Solitaire portfolio, as we speak yesterday, 17 companies have delivered numbers. Broadly, top line has grown at 16% and bottom line has grown at 15%, when India is growing 11%. So a very healthy operating numbers. And valuation, as I told, it's a tale of two story where there is a pockets of exuberance, undoubtedly, but there is a pockets of reasonable and cheap. So we cannot brush it everything as one go. And I strongly believe there is good opportunity to invest. So with this, I would hand over to Ganesh to speak a little bit on our product, and then we will open up the floor for question. Thank you. Over to you, Ganesh.
Thank you, sir. Thank you all for joining us today. And I hope some of the questions that you've had in your minds have been answered very elaborately by Mr. Balaji. So moving on to the answers, right? So once we get an answer to the question that we've had in our mind for a very long time, what we do is we want something to execute so once we agree with an answer, right, we want something to execute the answer with. So which is why we thought it would be great if we could discuss the salient features of our multi-cap product, Solitaire. So what is the USP of Solitaire? So Solitaire, when we ideated it, it was very clear. When we ideated Solitaire, it was very clear that we need to give a customized portfolio to every client of ours. Why? Primarily because markets are very, very contextual, right? Let's say you are a client who joined us 1 year back, and you're a client who's going to join us tomorrow. The whole market context is completely different over a period of 1 year, right? It has changed completely. So what we as advisors need to do justice as advisors to you, right? We need to create a customized portfolio which is relevant to today's market. So when we do that, we tend to look at businesses of the future, because when we invest, we need to look at the future and not what has happened in the past. Right? We here, I mean, with a general investing perspective, right? Or rather, if you look at an investor who's been in the markets for a long time, he always knows that the future, we need to be investing into businesses of the future, because what the past holds for a specific business or a company may not be the same what the future will hold for the same company. So we would be looking at it from a future perspective, albeit giving a lot of weight to how the company has behaved in the past as well. And obviously we need to look at opportunities before we buy. So there would be multiple opportunities in the market at different points of time, right? As Mr. Balaji had mentioned in one of the previous slides, when 2020 happened, or even when 2018 happened, nobody would have known that in 2020 or 2021 we've had where we had all these hurdles, right? If people had thought about it at that point of time, whether they would be investing into the stock markets at that point of time, they would say, okay, all these problems are going to come. Let me wait till all these problems go away and then invest. So if that had happened, they would have missed a huge rally. Right, so that was what was the point made by Mr. Balaji in one of the previous slides. So what we need to do is we need to be very opportunistic with respect to our buying, and we need to be specific. We need to be stock specific or idea specific when we buy it. And Solitaire is going to be a low churn portfolio, which is going to follow the buy and hold strategy, which is the fundamental philosophy of ithought. If we move on to the next slide, where we look at the risk reward of Solitaire. When we ideated Solitaire, we were also very clear that it needs to be a moderate risk-taking product with the return expectations well set. So what we expect from Solitaire is around 700 to 900 basis points over the average inflation rate of India. So why we did this is because It's very simple. We wanted Solitaire to cater to a wide set of investors. We wanted a scalable product where you can keep contributing money to and compound your capital at a decent rate, albeit taking a low to moderate risk while investing in this product. And what is it that we always believe in? So I would like to take a little bit of time in this slide is because in one of our Solitaire presentations that we had already talked about, we would have talked about a winner that we had rode on for a considerable period of time and about a loser that we sold based on its fundamentals. So why is it important that we have both these, right? So once we look at winners, right, it's pretty common for everyone to say that, okay, if I want to invest into an idea, I should believe that it should be a winner, right? But that doesn't always happen. Investing is going to be a sum of multiple variables put together. So I'm going to have winners and I'm going to be having losers as well. So when we have winners, how do we write them, right? We need to write them by looking. So Balaji sir had also mentioned on one of the previous slides that our idea maintenance is something that we take a lot of, that we put a lot of emphasis on. So idea generation is one thing, but idea maintenance is something that we keep doing 24/7, 365 days to make sure that we are riding the winner. Because if we spot an idea and that turns out to be a loser, there is no point in waiting for it to lose more so that uh, uh, we do not end up protecting our investors' capital by riding onto a loser. So what we do, we need to sell the loser at the opportune time. So we had a winner as well, which is KPIT Tech, which almost all of you would have seen in one of our earlier presentations on Solitaire, which we held on to a pretty long time before we took an exit. And if you look at KPIT Tech, it had multiple levers of different situations, right? Where it confirmed our thesis on at multiple levels. So when we started off buying it, we bought it around 80, 70 to 80 rupees. And then during COVID, it came down to 40 rupees, where we still bought more. And at that point of time, when people contributed more to their portfolios, believing in our philosophy, right? They're all big winners today. At the same time, we had a loser, which is again, Aegis Logistics is one of the stocks that we had in our Solitaire portfolio, where we started off well, but then beyond a point, the company's reactions or the company's behavior towards its investors and the way it was moving from a capital light model to a capital intensive model was something which is a big red flag to us at that point of time. So when we buy, right, we can always be very, very gradual when we buy. We can wait for a specific event to happen and then confirm our thesis and then buy more. So even if we lose out on an opportunity of buying lesser, there's always going to be another idea. But in case of selling a loser, a potential loser in terms of fundamentals, what we need to ensure is the selling needs to be sharp and at the right time. We got that right, and the experience is there for our investors to see. So this is something that we always believe in. A long-term investment success of an investor is going to be a combination of these two, and it is not always going to be just riding winners, or it is just not going to be always figuring out losers only. So because you will have to have a good balance, or you will eventually have a good balance of both. And it is our endeavor to make sure that the riding winners bucket is much more than your selling losers bucket. That is why we are here for you, and that is what we believe in. And with respect to that, if you look at the next slide, what your Solitaire portfolio will look like in the next few years will exactly be a combination of these three. So you will definitely have a few big winners like ITC or KPIT. You'll have multiple optimum performers, and you need to be patient with them, right? Because as Balaji sir was mentioning in one of the previous slides, you need to be patient because once the fundamental performance is showing up, right, the price will eventually show up. So that is what we have seen in the past with our fund management experience. We need to be patient. We need to keep regular checks on the business performance, track the business metrics regularly, do our idea maintenance, keep following the process and trust the process to make sure that you will, and be patient, obviously, to make sure that you will ultimately gain your rewards. And you will definitely have a few losers as probability, the law of probability suggests you can't get everything right. And the best fund managers in the world get around 6 to 7 ideas out of 10 right. And with our history, we have gotten a little bit marginally a little bit more than that, and we intend to keep up that run rate in the future as well. And the final question. So we've had a question of where is it the right time to invest? And if I invest right now, do we have enough opportunities? This is something that we keep asking ourselves, right? As advisors or as portfolio managers, we keep asking those questions ourselves. Is it the right time to invest? Is the market cheap right now? Are the stocks or are the ideas that we are buying cheap right now? Are they intent? I mean, is what is expected out of them? So once we do that, we also reassess our own performance. What did we deliver by following the answers to these questions that we had ourselves as portfolio managers? Just for your take, and it's our performance numbers since inception. We've done very well. It's on as of 30th of April 2023. If you look at across all scenarios, across all time periods, we've done well against the. If you keep the BSE 500 TRA as the benchmark, we've done very well. And even if you exclude the benchmark from it, it is something that is very desirable for a 3 to 3.5 year or a close to 4 year old product. And this we definitely have done it because the support that we've got from all of you in terms of buying at the right, I mean, giving supporting us during times when the assets are cheap, right? Like Mr. Balaji had mentioned, when the assets are cheap, you would get a call from us saying, "Oh, sir, these are assets which are cheap right now, where we would like to deploy some of your money. So we would request you to participate in this correction so that this will aid your portfolio." So as he had said, this is something that where you're giving money to your own portfolio and not to us. So you're feeding your own portfolio, which will eventually result in rewards, as we have seen in the past. So I'll
Just
give you
Ganesh,
yes,
just 2 points to add what Ganesh has said. What is so satisfactory for us is if you see last 1 year and 2 year, where markets are broadly did not have a major run, right? So if you remove last 40, 50 days of a run, the 2 year return was sub 10%. And we had a very healthy, strong double-digit return during a 2 year period, even a 1 year period, right? So clearly reflects during a very flat market also, the capital can compound at a very decent rate. The fund fell very lower than the market, right? Which clearly reflects the quality of balance sheet, how we went about managing the risk. So at the numerator, everyone knows this number, right? So since inception, 20.27 vis-a-vis 17.20. But what I also want to reiterate is this has been achieved by taking 25% lower risk. So at one end, by taking lower risk of 25%, which is reflected in quality of balance sheet, to put in perspective, 82% of Solitaire portfolio is debt-free, cash-rich companies. Portfolios are fully profitable, right? And beta is 0.75. So the portfolio is lower risk in terms of quality, in terms of this one, right? Which clearly reflects lower risk at 25%. At the same time, we have delivered reasonably a 300 basis or 400 basis over the market. So returns have been better and risk is lower, right? That's where the proposition is. The general belief is, okay, you have to take higher risk and to deliver higher return. We strongly believe to deliver a very sustainable long term, you have to actually take the lowest point of risk and be patient. I think giving a 4-5 year time frame for investing and taking low risk, definitely India provides a fantastic opportunity. And we have built a fantastic team in the last 4 years with 10-member overall fund team, predominantly CAs and CFAs, and we all based out of multiple locations, not only in Chennai, a couple of them based out of Bangalore, Delhi, and Bombay. It means a very wide team has been built to run this entire products, which we have 4 products altogether as a house. I think with this, we would like to thank all of you who have attended. We'll open the floor for a question and we'll be very happy to answer any question regarding the markets or the strategy, how we think about. We'll be happy. Thank you. Thanks once again.
thank you, sir. If you would like to ask any questions, please type out your questions on the chat box. If you look at the chat button, it is on the top left corner of your screen next to the timer. So you can click on it and the comment box will open up. There you can type out your questions and we'll be happy to answer them.
Ganesh, you can answer this.
Yes, sir. Thank you. The first question from Mr. Ramasamy V is the return CAGR year on year. Do we have XIRR? So the returns that we saw on the performance slide is all TWRR, which is time weighted rate of return. And obviously beyond 1 year, it's going to be CAGR, so compounded annual growth rate.
Okay, thanks. The next question I'll answer, Ganesh, in terms of sir, of late I received call from our team for SIP. How good is to compare with MF SIP? I think it's a similar structure. The good about SIP is if as a fund manager we get sight of the cash flow which is going to come consistent, right? We will not miss out any opportunity. So it serves two purposes. I would say the heavy lifting is done by my investor who has been very disciplined and giving capital so that I'll be not constrained by short of capital. We strongly believe selling is very independent of buying. So one of the things which we are very unique as a house is we don't just sell because we have to buy a new idea. There are two ways we handle. We try to, that's why we have our own distribution channel to talk to our own clients and say, there is certain more ideas which we can observe. If you have a capital, which is again a long-term capital, a surplus capital, which can come into equity, we'll be very encouraged to give capital. Otherwise, we will see if the existing stocks are reasonably good and the forward IRR of the portfolio is extremely robust, we don't end up actually selling it. So I think SIP is a very good way. We encourage strongly. It helps both the investor to save capital and it helps us also to plan the portfolio better because as I told, investing is a journey. It starts with 50 lakhs and as we keep growing, right, it's going to really build on. And it's not about, right, you buy and then after 4 years you do a review and you shut it. No, that's not investing. Investing is a very long journey. And definitely we as a house believe in a long journey. And that's where we are encouraging our investor to be the same. I hope that answers your question, Sampath sir. View about insurance sector, it's been underperforming in the portfolio. Yes, sir, I think, see, insurance is a what to say, a very interesting sector. We strongly believe India has done enough banking in the last 2 to 3 decades. India will do a lot more insurance, a lot more asset management, wealth management, broking. So it's a very strong sector. So to put in one perspective, so there are 2 types of insurance, general and life. General is a very, very interesting category. I'm sure if you're an investor, you know, we are very bullish on the segment simply because the sector itself is growing at 17-18% for last 2 decades. And you have great companies available at a throwaway price, not only on relative valuation, on private market valuation. And if you see, next 2 trillion of India's GDP is going to be more of a manufacturing, which requires a lot of insurance, right? So from a service economy, we are going to become a manufacturing economy. We are going to be an economy which is going to export a lot. And a lot of these things need insurance. In the life, the biggest interesting thing is your term policy. I think India is just simply, we just don't have term policy at all. Neither we don't have or we are under invested. So clearly we believe it's a sector of a decade. Obviously, last 2 years, price has not performed for 2 reasons. One, to start with, the valuation was slightly elevated. Second, you had FIS selling, which the last 30 days it's got reversed. So you see some performance in insurance. And finally, you had a regulatory change in the on the budget, which is a short-term headwind. But we think it's a sector of the future. And I think we have to keep monitoring the premium collection, which is continuing to grow between 15-20%. That's what I say. We should not measure the performance of a sector or an idea only by stock price. In the medium term, stock price do reflect fundamental. But I think our insurance is a very growth sector. And we do have a positive view, but obviously at a right price, not at any price in any stock. How is Solitaire offered to customer through MF or a PMS? It's PMS as a house, Solitaire and all the 4 product it's out of PMS and the minimum investment is 50 lakhs. That's by regulation. I hope that answers Karthik question. Are you looking at any opportunity to invest in US market? So far, this fund concerned, it's a 100% India domestic fund, sir, Kumar Nachalam. So this fund will be only investing to India. I think definitely there are few funds specific to US you can look at. But for all India opportunity, I think a one-stop solution will be Solitaire, where we continue to invest, keeping 4-5 years perspective, taking the least amount of risk. And that's what our endeavor to do in Solitaire. I hope that answers your question, sir. And any view on commodities as it is cyclical sectors like steel? So in Solitaire, as we've been communicating, our objective is not to hit for fences. So it's a product for a very durable long-term game, right? I would say like a test match where you have a horizon of a 4-5 year and then want to be as long as possible with a lower risk. That's a Solitaire. So typically, see, commodity cyclicals are not bad. I think every sector are cyclical. Some sectors are deep cyclical, some sectors are shallow cyclical. That's point number one. But when you have to think about cyclical stocks like steel, there are many factors which will become very difficult from a public investing where the price action can be very vulnerable. To put in perspective, the largest IT company drawdown in the last 20 years, drawdown is typically from any price, how much it can fall or it has fallen. The largest IT company, which is TCS, generally doesn't fall more than 20% any given time in the history of the listing, 20-year data. But if you see any steel company can fall easily 50, 60, 70%. So I'm not saying it's good or bad, but it's very volatile. And in Solitaire, our endeavor is to be a little more stable. So we generally don't end up having any cyclical stocks, deep cyclical stocks like steel. That's my perspective. Otherwise, standalone, every sector is relevant. If you don't have steel, you cannot build infrastructure. But in Solitaire, just to touch upon how we are capturing steel growth, we are having a very strong MNC which serves the steel company as part of consumable. It means to manufacture a steel at the 1600 temperature, you need to use a consumable, and these consumables are very profitable and they are not very cyclical. They are debt-free, free cash flow, dividend-paying companies, MNC companies, high governance. So we have a couple of them in our portfolio to capture the infrastructure growth, but we don't have any steel as of now, not intend to be. I hope that answers your question, sir. Your view on financial sector like wealth, financial, we are pretty positive. We believe India's next 10, 20, 30 years, financialization will really will take up because this generation is traveling a lot. They are settling in not in one place, right? So most of the wealth we believe will be morely into non-physical, which is in financials. And the segment which you have spoken, we are very bullish, not only for growth, but interestingly, if you see, most of the sectors are balance sheet light. It means they don't need a capital to grow 1x to 100x. It means they're going to give a lot of free cash flow. So you're going to have a sector where growth is good and going to pay a lot of dividend, right? We love that sector, but obviously, right, a right stock at right price is always more important than talking very generic stuff, right? Because buying the best company at 80 multiple, we believe it's not a great way. You have to buy the same great company maybe at 20, 25 multiple and then make the good money, right? So investing is not about only the sector, but we are very bullish on the segments you have called out, sir. That's for Krishna Kumar, sir. I have invested in international fund of fund by Franklin, now almost 20% loss. Is it right time to come out? Suresh, okay, sir, I think maybe this is not a right forum. I would request you can get in touch with our other colleagues who can help about looking at a particular fund. But broadly, I can talk from an overall global point. The data is going to be mixed. Growth is going to be low. And maybe, but your interest rates also peaking, right? So maybe we are there. But I would request you to get in touch with our colleagues to be a little more specific on the fund. I hope that's satisfying your need. Manufacturing may not grow like China or Taiwan. Will bad labor law, in my opinion. I think I'm sure, sir. You're right. We have slightly tough more than maybe other country because we are very democratic. We give more freedom than what sometimes I believe we deserve. But I think the time has come. Just put in perspective. If you go to 600 company does con call every quarter and the corporate commentary on manufacturing, right? Every MNC out there trying to set up their manufacturing more in India. So we might not become China, neither I don't think our endeavor is to become China, but can we compete with them? Can we grow? Can we have a better opportunity to grow? The answer is yes. please look at your EMS industry, which does manufacturing for your mobile phones. They are growing at 100% and so on and so forth, right? So clearly, India is pushing towards manufacturing. Our intent is good. Will we become China or Thailand? Let the time answer. But I think directionally, definitely manufacturing activity is picking up and reflected by the corporate India's number also and the capex they are announcing now. Just see L&T slide. They're pointing out capex revival in manufacturing, which clearly reflects the behemoth talking about it. Just a data in point. I hope that answers your question, sir. As a central election is an offering, do you feel there is a good opportunity now rather than close to? Sir, I think opportunities every time. I don't know the outcomes of election, what will happen before election. All I can tell is, as I told, there are 201 stocks are lower. There are few IT stocks are much, much lower now. Maybe after 1 month point in time, there could be some other segment, right? So my only thing is start the journey and plan for, okay, I will be a little more disciplined in next 1 year. So initial part of journey, you should contribute a lot. As the journey settles, I'm sure the fund will start reflecting. That's where I would like to end. There is no right or wrong time. There is only, but you should have a capital of a 4 years. If you have a capital less than 2 years or 3 years, definitely equity is not, and definitely not ithought, because we are well served for investor who also has a long-term capital, because our decision making is clearly keeping 3 to 4 years perspective. I hope that answers your question, sir. In today's market situation, when gram value investing will work? I think every investing is value investing according to at least me, because what is value? You buy an asset, but you pay lesser from a price. Value gets created by growth, because if a stock doesn't have, or a business doesn't have a growth, the business will become a bond. So growth is a very, very inherent part of value creation. We are very clearly believe the value is created by selling more, converting the sales into operating profit to PAT to cash flow to dividend payout, right? So this is the mechanism to create value. I don't think there is no change, but we do believe you have to pay with keeping all the risk in term. So we are a strong believer of buying great business, but at a price. What last 2 years before, the big narration is you buy good company at any price, you will make money. I think people have clearly realized that is not investing. That is speculating, in my view. Investing is, so to put in one of idea, one of a very large engineering company which does consumable for cement sector. We did the research in 2020. We liked the company, but we did not invest because the valuation was frothy. We waited till 2021. Around the end of 2021, the stock got corrected for temporary reason by 30% and we bought fully. So the whole idea is not that researching and buying is not easy. You have to research good company, wait for the right price, and that's what we endeavor to do. And that's what we have done. And that's what it delivered in the numbers. I hope that answers. Value investing always will work, but not purely buying company which the customer itself doesn't go, right? So there is a one media company, I keep thinking the next generation doesn't even know the company exists. So where is the terminal value? There is no terminal value for that company, and which is very popular out of South India. So think about business where there is no consumer, which is the next generation is not even thinking about the company. They don't even know. It's not value investing. It's basically hope investing. Value investing is buying a great company like an IT industry going through temporary problem. And I think we truly believe that's where the opportunity also lies. Hope that answers your question, Ram. Harini, does investment in my portfolio change if I change my risk profile? No, this is a Solitaire portfolio will be a unique portfolio for you, but it doesn't change because of your risk profile. The portfolio will be always going to be run as a low to moderate risk. And I think if you turn to be a high risk investor, so there is no investor called high risk, right? A portion of the portfolio could be high risk. So you should give money to Solitaire, which is a portion of portfolio which wants low to moderate risk in equity. I think that's a capital should come into Solitaire and not a capital which wants to take high risk. We have other solutions like Vriddhi, where it's a small and mid and micro cap, where we take slightly little more longer view, but the endeavor is to deliver little more higher return than the Solitaire. So that could be a solution if at all you wish to be. View on infra and rice sector. Infra is really flourishing. As I shared to the previous participants, we don't play pure low-end infra stocks in terms of business, which does contract manufacturing for government, where the cash flow can be a problem. The way we participate is the second order business where the main business has to buy some consumable, some electrode to do the manufacturing of infrastructure, right? That's how we participate because these plays are very clear because their customers are private company. So cash flow will become easy and they are typically a debt-free company, high ROC, right? And very difficult to dislodge because these relationships are very durable. So that's how our view, but infra is really, really positive. We don't have any specific view on rice sector. Again, in Solitaire, no stocks around that one. It is a pure commodity generally and tend to be very volatile. If you find a great opportunity in a company with less than 1,000 crores, will you consider? Okay, that's a good question. Typical today, our fund size is happy to share. We crossed 500 crores day before yesterday with 3.5 years to 4 years track record with no distribution, with entire support of my team and our investors who have contributed consistently. We have gone here. We wish to go much larger place. So we generally end up taking stocks above 1,000 crores. That's our current criteria, but we are slowly pivoting above 1,000 crores. Definitely no stock is bought in generally less than 1,000 because already the fund size is 500 and liquidity issues do come. So most of the ideas in the recent last 10 is only about 1,000 crores. Hope that answers your question, sir. Is a product spectrum of ithought among, is there opportunity for customer for pre-IPO? No, sir. We don't, at least so far, the current solution doesn't entertain any pre-IPO. And coming to Solitaire, one of the best thing happened in Solitaire is we avoided all the frothy IPO happened in last 2 years, keeping two reasons. One, valuations were skyrocketing. We said, why do we deploy money where the assets are very, very expensive? So it doesn't make sense. Second, there was very limited data. So one thing which my existing investors should feel happy, and we are very thankful they're given that opportunity to demonstrate. We have been a very disciplined capital allocator. We did not do anything rocket science, right? We've just been very disciplined. I think the discipline of investor and ourselves is what got rewarded. So we don't entertain generally IPOs unless it's exception. But last 2 years, no IPO has been done by us. Thanks for the answer. Thanks, sir, for your response. Thanks for giving me clarification. Thank you. How do you see AMC and broking firm for next decade? I think both are very different business, but definitely India have come in terms of number of people who are trading right now. We strongly believe at least these are very, very forward-looking industry from two things. One, after people have tasted equity, it's going to be a matured way of approaching the markets. The way to be matured is you will become more engaging with platforms which are more durable, which is giving right infrastructure and right incentive. I think cost is not the only factor which we believe is very, very important because if you have a wrong infrastructure which is going to induce wrong behavior, it's going to cost a lot. So we truly believe there are few broking infrastructure company which are trying to be a balanced one, which could be a beneficiary. So definitely it's a tough industry, but this industry has survived and definitely need of the hour. The model can be very different, but I'm sure few will definitely here to make money. AMC, we are far more bullish because for a common people, it's continued to be a great platform. If you see any balance sheet of an asset management company, they typically tend to be debt-free, cash-rich. They don't need any capital to become 10 size of this. So next 10, 20 years, the big trend is SIP. As we speak, our SIP book is close to 14,000 crores, which used to be 3,000-4,000 crores, maybe 5, 7, 10 years back, right? So clearly, Indians got used to save money using SIP. It's a mega trend. The next mega trend is ETF, where all the wealth management will use ETF to build quality portfolios. So we strongly believe AMC is what is the sunrise sector. Obviously, right, every sector will go through their challenges. And obviously now this sector is also going through their own share of challenges. But I think we strongly believe it's a sunrise sector, primarily from decadal opportunity and a clean balance sheet and clean cash flow. In Solitaire, how much percentage holding in large cap investing? So as we speak, sir, we are 35% large cap. 15-20% mid cap and the balance in small cap. We typically generally have a fully invested portfolio. Our endeavor is to, as long as you own a good company, you don't have to do this taking a cash call and trying to be very smart, because it's anyway a durable long product, and we are at 35% in large cap. So we will have a good mix. The large cap percentage actually went up in the last 2 years because we clearly saw the froth is in small cap, and the large cap was a little more reasonable. So we had a lot of large cap in the last 2 years, and wherever the opportunity lies, we will go. And I can be rest assured for you all, we will not take unnecessary risk. That's a proposition, and we continue to commit to our deliver, right? That's our promise. What is PMS SIP? Please explain. Thanks. So SIP is simple. You engage with us in terms of first you have to enroll for the PMS, which is a 50 lakhs. After that, what systematic investment plan does is you commit your 2 lakhs capital every month. So from a manager, I get 50 lakhs on Jan 1st. So every first of the month, I get 2 lakhs from you. So by 12 months, you would have saved 24 lakhs. For a manager like us who allocates capital on behalf of you, I get the visibility that every first, my customer is going to give me 2 lakhs and I can buy stocks, which is very attractive for their own portfolio, right? So your portfolio will become far more customized because your capital is coming in a customized way. That's SIP for you, sir. Okay, my investment in ithought is distributed as 70% PMS, 30% MF. Is it wise to shift to 30% MF to PMS? Should I continue? I think always I would prefer to be a very balanced investor. Definitely a various instrument serves very different needs. So I would request you to engage with our relationship team member to see how to keep this balance. But if you were to ask me, generally I would prefer to keep capital in both. To put in perspective, even my personal capital is a function of all the places, right? So it doesn't belong to only one area. So I think a balanced approach is much better. But incremental capital, you can think about where to put based on your consultation with the people. I hope that answers your question, Sampath sir. How is Solitaire performance trending compared to other multi-cap? Okay, it's something which we have done phenomenally well. To put again, right, yesterday SEBI came with the data saying on a 5-year perspective, 45-50% of the country's product underperform benchmark. And obviously, right, 3 years also close to 30-40-50% of the funds underperform benchmark. And you have seen our fund has outperformed the benchmark by 300 to 400 basis points on day we talk. And this outperformance came with a 25% lower risk. So if I adjust the risk adjusted, right, that's a way every fund has to be monitored, because the input to output ratio, the risk is lower, but still we have delivered better. So we are like a substantially better, very close to the top quartile, few top stock funds. But that's not our comparison. Our comparison, our proposition to you is we continue to deliver what we are committing, which is a medium term, very good, healthy returns on 3 to 4 years. But in the past, we have been on the top, and that's we are proud, but we don't want to showcase only that, because that's an easy way to sell. But that is not, it is not something which I'm going to promise you, right? Next 4 years, we'll be number one. That's not our promise. Our promise to deliver consistent, stable, long-term performance. Instantly, we can be number one, and that's what happened last 3.5 years. It's not that something we planned it on day one, thinking that we want to be number one. That's not our, neither we can plan it. I hope that answers, but we have done extremely well. If you want personally, you can just ping our colleagues and they will share the data. But then I can rest assured, like we are in top 1, 2 out of 1,000 odd funds or 500 odd funds. That's it. Thanks, sir. Any other question? We'll wait for 1 or 2 minutes, Ganesh. Otherwise, thanks, DG sir. Thanks, Sampath. Thanks, Ramkumar. Thanks, Janardhan, Natarajan. Thanks, Partha, sir. Thanks, Kumar. Thanks. Thanks. Thanks, sir. We are happy to serve you well and continue to serve a long-term investor like you. Thanks. So one question, I have capital of 25 lakhs, any option of investing with you? Yes, sir. In PMS, it's not possible because by regulation, it is 50 lakhs. But what I request is, so we have a fantastic platform which serves multi-dimensional one through people who have less than 50 lakh capital, where we use the other instrument like mutual fund, ETF to build a very robust portfolio. Our long-term track record of 12, 13 years is there to prove. We'll be happy to serve you there, and you can get in touch, or Ganesh ask someone to get in touch with Mr. Naveen, sir. We'll be very happy to serve you, sir. And maybe after 50 lakhs, you can take a consideration to be there, or you can come to Solitaire, any of our 4 solutions, which we are here to serve you. Alpha 3% calculated. No, this is after fees. Every single return which we have put out in the public domain is post fees. Fees is already taken. The endeavor is, to deliver sustainable alpha. But you have to adjust the risk also. The alpha is not 3-4%. Actually, alpha will be like 5-6-7% because the risk is 25% lower. Hope that answers your question, Mr. Kumar. Thanks. Okay, sir is with Vriddhi also. Hope, yes, sir. We're all committed to serve you well, sir, in all the 4 funds. And do request you to support by referring clients. That's how we can grow. What is alpha and beta? Okay, so beta is a measure of fund risk. It reflects how much the fund is volatile. So a beta of 1 is the fund is equivalent to market risk. If the beta is lower than 1, the fund risk is lower than the market risk. In our case, the beta of Solitaire is 0.75. That's why I said we are lower by 25%. And alpha is, so if someone delivers 12% by having 1 beta, when the market has delivered 10, so you are expected to do 10%, right? Because the beta is 1, the risk is equivalent to the market. So you are expected to do 10. But if you deliver 12, the alpha is 2%. In Solitaire, we have delivered the returns with 0.75. It means at absolute alpha is there, risk-adjusted alpha is significantly higher. That's what I commented. I hope that answers your question, Harini. Sir, if substantial investment is done in Solitaire, is it worth investing? Of course, it's Spear. It's not Vriddhi and Spear. Definitely, we have 4 solutions. We have True Blue, which is a pure large cap, 100%. We have Solitaire, which is a multi-cap. We have Vriddhi, which is small, mid, and micro cap. And we have Spear, which is a multi-asset, a very unique product where we have a long track record. So if you have investment in Solitaire, definitely you can consider, but something is very personal. I would request we can have a separate conversation with our team, and hope they will be able to tell what is the next best idea can be complemented to your existing portfolio. But we'll be very happy to serve you, and we'll be able to give you our thinking behind how to think about it. Mr. Kumar, hope that answers your question, sir. Sure. Ganesh, can we, if no more question, can we end? So
Yes.
we'll be very happy to take any question offline also. Our contact numbers and this ID is there. And we have a very active PMS page in both LinkedIn, Twitter, and YouTube. We are happy to serve you and looking forward for you to be our client and take it forward. Thank you. Thanks for joining. Let's have a fantastic year ahead.
Thank you, sir. Thank you, everyone, for joining us today.